All right, we're live. Hey there, it's Mitch. Welcome to the live stream, Be the Boss of Your Money. All right, so NASDAQ just is about to close the quarter. Just a couple more days. If we could just hang in here, we have the best first half of the year for the NASDAQ since like 1983 or 84. A number of mega cap tech stocks have led the market. Microsoft, Nvidia, Tesla, the name, Amazon, Alphabet, the names that we always talk about. Now, a week ago, we are talking about the rally spreading out and getting into reaching more stocks. And that continues because even yesterday when the NASDAQ was down, we still saw a pretty good move up in the rest of the market. And that's why yesterday the Dow was down a measly 12 points. It's nothing really, even though the NASDAQ was down 1.5%. So we are still, in my opinion, in a pretty strong market. And just because we had a 6-day losing streak in the Dow, it's not like it was plunging. It was a pretty small incremental drops. And that kind of highlights the whole year. This has been a really low volatility year. There were just the extremes have been quite low, and that's indicated in the VIX. It's a way we track volatility, the VIX, the volatility index, and that's been pretty low, remarkably low all year. Anyway, I'm going to roll the intro. We're going to talk about why, not only is it a waste of time to sit here and call a recession or not call a recession, it's not going to matter for stocks. But what we need to really do is talk about what it means for you specifically. So we'll roll a quick intro and then we'll get off the air. So stick with me. We're going to talk about a couple of important things you're going to want to know. Here we go. All right, so a couple of big things. I want to give you some big picture stuff. Let's first of all go into what we know. All right. Labor has been consistent. Let me just switch cameras here. All right, that's better. Labor has been consistently very strong, much stronger at this point in the cycle than anyone would have expected. What cycle do I mean? The Fed has raised rates 500 basis points in about a year. They paused the last meeting, but we're waiting for we're waiting for this tightness in the market and the money supply to actually impact labor, and it hasn't. Money is tighter. There's less money sloshing around. It's a little harder to get loans, a little more stringent for banks bank underwriters, loan underwriters to approve loans. But nevertheless, labor is still pretty strong, and recessions happen after labor gets weak, not while labor is strong. So we'll have to just watch out for that. I know you want the future, but let's get into what we know first. As far as the stock market goes, everybody said if the Fed raises rates to a large extent, and the Fed has risen interest rates to a huge freaking extent, stock market is held up remarkably well. Granted, we had a real big dip last year, but it's recovered a lot to the point that the major averages are not that far. I'm talking especially about the Dow and the S&P. They're not that far from reaching all-time highs. Okay, it's not a stretch at this point to see both of those averages hit new highs before the end of this year. I just have to say you can't invest directly into an index, but you could invest into a security that tracks or mimics an index. There's a distinction. It needs to be made. So we could see highs. Now, I think the two big stock stories today show what recessions could really be like. Walgreens stock tanked today, and in spite of that, the Dow Jones was still up today. Let's just give you Well, I won't punch up a quote now. Well, maybe I will. Walgreens at the end of the day was where the okay was down almost 10%. New 52-week low. Walgreens has been like just like the worst stock in the. I think it's even worse than Intel for like the last I don't know 10 years. Ever since it got added to the Dow Jones, it's just has not been a good stock to own. At $28 a share, it actually. You want to know why Walgreens didn't have a big impact in the Dow today, even though it was down 10%? Because it's such a low price stock compared to the other stocks in the Dow Jones that even if Walgreens went down by 50%, it would still have very little impact on the index because the index is price weighted. So a $28 stock now is not that big of a deal to the Dow. I don't even know why Walgreens is still in the Dow. There's certainly nothing industrial about it to be in the Dow Jones industrial average. But then again, I've been saying this forever. The Dow Jones industrial average is not really an industrial average anymore. I don't really know how or what constitutes this. I don't even know how the stocks are chosen for the Dow Jones. But if you want a real measure of industrial stocks, you follow an ETF, an exchange traded fund that goes by the ticker XLI. Okay, that's the Spiders S&P Industrial Stock ETF, and that is a much better way to track industrials, and that is trading just about at its all-time high. So if we're going to a recession, wouldn't you see that ETF going down? Right? If we're heading into one, that should be trading it, in advance of a recession, so it should be going down. The other thing is we had this quote, this quick banking crisis. You saw Signature Bank, certainly Silicon Valley Bank, a few other banks tanked, but that was it. The problem was, I don't want to say solved, but the domino effect was stopped. The Federal Reserve backstopped everybody. And, we were talking about this crisis in the banking sector, which when it ended as quickly as it started. And then we had the debt ceiling issue, and that was a big thing to talk about, and that went away. We had the beginning of the Ukraine-Russian war in February of 2022, and then we had this little mini mutiny over the weekend, and by the time we came in Monday morning, it was pretty much over with. It's not really an economic problem. It doesn't really affect the global economy. Russia's economy is tiny. They do almost no business with the West. All they really do is they sell cheap oil to China and to India. That's all they do. They sell cheap oil, and nobody's buying their manufactured goods. Russia's always been a big exporter of arms, but they can't export arms anymore. In fact, they're asking countries to give their arms back. They need weapons back because they're running out of stuff because of a war that they expected to fight for 3 days and win. And now they're, almost a year and a half into it, and they're still not even close to winning this war. But they're going through a lot of people and a lot of equipment. So why should we go into a recession? The Federal Reserve has indicated, as far as we could tell, that there's 2 more quarter-point interest rate hikes left. Not a huge difference from where we are now, 5.25 to maybe 5.5, 5.75. Not incrementally that huge of a difference. That's not like going from 2% to 3%. There's still money to be loaned, and we're talking about Walgreens. Part of their problem was that the big numbers that they had from servicing people with COVID for drugs and antihistamines and whatever else people were buying, Tylenol and Advil, that has gone away. Walgreens has also said that people are spending less money, they're being more choosy, they're being more value conscious. But then Delta Airlines sent the whole airline sector up because they're having a booming quarter and their planes are full and people are traveling like crazy. So let's define a recession. A recession could be 2 quarters in a row of negative GDP, which we already had last year. It could mean other things. By the way, that is not a strict definition, 2 quarters of negative GDP. That typically happens when we go into a recession. That by and large, according to the NFIB, who the body that calls recessions in the United States, does not use that at all as a definition of what a recession is. So, having said all that, it's really tough to make a really solid argument for a recession. Now, don't get me wrong. We could go into recession, and there's a few smart people who I listen to are telling me we're going into one, and they rattle off a bunch of statistics that back up their claim. And I can tell you there are very smart people who are saying we're skipping a recession. But what I could tell you is this: think of recessions as they don't affect the whole economy. It used to be 30 years ago. If we went into a recession, it affected almost everybody. But today, a recession might impact auto manufacturers. But will it impact housing? The price of houses went up 3 months in a row. That news came out today, according to the Case-Shiller Index. Price of housing. Well, I don't see a housing recession. So maybe we could have different rolling recessions in different parts of the economy. And by the time one is over, another one begins. But we're a much more diversified economy than we were 30 years ago. Our economy is also much more technology centric than it was 30, 40 years ago. And technology is consistently evolving. And we could get into the internet, we could get into artificial intelligence and all those other things. Now, as far as the stock market goes, people say every time someone who's bearish in the stock market who wants to convince you it's going down, they always say the same thing. Well, look at the economy, this, the economy, that. And I think it's a mistake to always run from the stock market to try to convince someone that the stock market has to go down by citing the economy. If the economy weakens and the Federal Reserve starts to cut interest rates, that could actually be very good for the stock market. And the fact is, we already had our 20% plus correction, 30% plus correction in the NASDAQ last year, 20% plus in the S&P 500. We've already had the correction leading up to a potential recession. Now we can have another correction. And listen, corrections can come out of nowhere. Recessions could come out of nowhere. Look at the pandemic recession. Out of nowhere, we've got this crazy pandemic, but we get through it. And I don't think investors need to make this all or none decision of pulling back, converting their S&P or their 401k into cash. I think those are consistent mistakes that people are going to be making. And the fact is, if your goals are 5 years, 10 years, 15 years away, you really don't have to do anything. 5 years, you actually should start moving to a more conservative posture. Money you need over the next year or two shouldn't even be in the stock market anyway, and you should have an emergency fund. So the whole point of this is to get to a very boring conclusion that don't be one of these people who overtrade yourself to death, because the biggest cause that I've seen in my career of people underperforming markets and losing money is trying to prepare for down markets, trying to prepare for recessions with their investments. They get it wrong. They sell too late. Even if they get the timing to sell right, they don't get the buying back in timing right. And what happens is when you go to cash, getting back in is even harder, because you're going to see the market go down again. You're going to wait for the market to go even lower because you say, well, it's going down, I'm going to wait. And then if it recovers and goes back up, you're going to say, no, I could have bought when it was lower. I'm going to wait for it to go lower again. And it just becomes endless procrastination. I think market events like we're seeing now are meant to throw you off your game. But now that you know that, hopefully you'll have more staying power. That's the key. I appreciate you watching. If you're new here, give us a thumbs up. Keep an eye out. I do this live stream every Monday through Thursday, usually about 4:30, but lately it's kind of more like 4:50, 5 o'clock. But that's just a summer thing. I've got to pick up kids and do all these things by the time I, between like 4 and 4:30. So that's just the way it's going to be. All right, that's it. Mitch Goldberg signing off. We'll see how the world looks tomorrow. The next big thing is next week. Okay, next week, I think the 7th, right? We have the non-farm payroll figures, and that'll be a really big tell in terms of what we think the Federal Reserve will do next. But I don't think you should necessarily walk around with this fear of a recession and fear of a severe bear market. I think you just need to calm down and realize that most of these very scary negative calls typically don't happen. And last, I keep saying this, the last thing is after the 08-09 market tank, all the way up till about 2015, 2016, the same analysts, the same Wall Street strategists are saying how bad it is. We're going to go lower. It's the worst thing ever. Nobody talks about that anymore. We get through the problems. Companies grow. They make more money. Bad ones disappear. We're diversified, so we get through it. And you just need to keep on. Diversification is a strategy that we use to mitigate risk, but it doesn't necessarily protect your portfolio from going down in a generally down market. With that said, have a great night. Talk to you tomorrow.